Today, we're unpacking financial drivers that determine whether your portfolio rises or stalls. We're talking yield, rent strategy, cash flow and buffers, negative gearing, depreciation, and long-term portfolio planning. I had a client a couple of months ago. He had 4 properties in 2022. The rates go from 2 to 6. All of a sudden, those properties are costing him about $3,000 a month, which we couldn't sustain. Panic stations hit. Panic sells them off. He realised if he actually just went down that strategy of setting up some buffers, he could have held those properties up till now, and they've all basically appreciated somewhere between 40 to 60%. We're a capital growth focused buyers agency. I guess from yourself, how important is cash flow when you're forecasting returns for a client?
Every $100 affects your borrowing power by about $56,000. If you buy a house at $500 at 5% yield, call it $500 a week. Compared to $400 a week, it's $56K in borrowing power.
In terms of negative gearing, in the simplest terms, what is it? How does it work? Who does it help? Who does it not help? And when does it, I guess, become dangerous? Welcome back to the No BS Property Investing Podcast. Today, we're unpacking the actual mechanics of returns. Not the hype, not what social media tells you. We're joined by someone who sits at the absolute pinnacle of lending in the industry. Mark Davis from the Australian Lending and Investment Centre. Not only is Mark one of the top brokers in Australia, he's been awarded Broker of the Year numerous times. With more than $4.5 billion in lending under management, he has shaped some of the strongest and most resilient property portfolios in the country. Good to have you in the studio again.
Nice to be here.
I guess first question I want to get straight into after that today, Mark. So when you're assessing properties for clients, is there a type of yield that you specifically like to see, from a lending perspective? And if so, or if not, why?
Yeah, from a cash flow perspective, it's very important because it allows us to obviously have borrowing power. And if it's too low a yield, the actual cost to run the asset's too high. So I'll give you an example. If you bought something for $500K and it was a $300, call it a 3% yield, or I think it's about 3.1%, or it's a $400 or $500, that $200 difference is enormous in borrowing power. So it actually affects every $100 affects your borrowing power by about $56,000. I just checked it out on the phone on the way here. So $56,000 for $100. So if you buy a house at $500 at 5% yield, call it $500 a week. Compared to $400 a week, it's $56K in borrowing power. And not only does that affect just your borrowing power, it also affects your cash flows and your end result, or what it costs to run the asset. So I'm not a big fan of a property costing too much to run, because it needs to be built in to the end result of what you're trying to achieve out of that property. So yield, to answer your question, yield is really, really important.
Yeah. And do you, I guess, 'cause from my perspective, from the strategy side of things when dealing with clients, I guess, do you have a set thing where that needs to be the same for every client, regardless of what they're earning or what they're wanting to invest, or is there a bit of flex on your side?
Yeah, there's always flex, because it might be the BA, such as Ripehouse, might be going out there and buying a particular asset that might be more land value. I just bought 4 in Perth, I should say just 3 years ago. In Perth, it's nearly land banking, so old house, old kitchen, old bathroom, low yield. So the running cost is an extra, call it $8,000 a year on each property. So for 4 houses, that's $32K a year. You've got to wear that, but it's got to come back in the return later. So there's always flex in regard to it. You might have a low-income earner who's a new investor who only is on $70,000, $80,000 a year. So clearly they can't get a property that's $300 a week. It's got to be closer to $5,000, because we want the running cost to be under $5,000 or $6,000 a year post-tax, which we'll talk about gearing later. But under that level, most people, when they do their cash flows, their budgets, etc., they can afford $5,000 or $6,000 a year. And when they know it's that number, they tend to jump in. But if that number's $10K or $11K, it starts to hurt.
Yeah, and I think that's where it becomes really relative to your situation, right? Like, I know from my side, I've got a particular demographic of clients. So let's just say, and I'll put them in one bucket, though everybody's obviously different. Like if I've got, say, surgeons, anesthesiologists, you know the type of where these guys are working 60 to 80-hour weeks. They're almost impossible to pin down, and they might be on $500K to $1 million per annum. And it just almost becomes a bit of a time trade-off for them, right? Where they might have a couple of $1 million worth of buying to do. And yeah, it'd be great. We could go out there and buy them $400,000-$500,000 properties. Yep. But the reality is to get these people in a meeting is almost impossible.
Yeah, example.
Yeah, they're not really worried too much about the cash flow side of things. And they also too, they might have certain biases, right? In terms of they're probably working in a major city. They only have that bias of, buying in a metropolitan location as well. So, and that's probably where, and as you were mentioning before, the lower income earner, you have to be willing to make more sacrifices and make that, I guess, that portfolio that you're trying to build.
Yeah, it's up to the individual, really. You'll see some really high income people, doctors and lawyers, and on very, very high salaries who are very cash conscious.
Yep.
So it's really about us as a broker determining the person and their risk profile and their comfort level. But ideally, if someone's on $500,000 a year, they're looking for growth. It's growth. Where it costs $5,000 or $15,000 a year, they don't care. Give me the growth. Type thing. So it's it works in both ways, but the growth is obviously the major driver, but yield is very important.
Yeah, absolutely. And I guess so on that yield, like where do you see investors go wrong and maybe push too hard for higher rental yields in some cases?
You see some people get a little bit greedy in tough markets where it hasn't been a tough market for a long time. We've got a shortage of property. There's a supply issue. There's rental issues. There's rental queues. You don't see that at the moment. But in certain markets where you do, you'll see people try and push it and up the rent and basically nearly push the tenants out. But again, we don't see a lot of that these days. What other issues are there?
I guess from my side, where I see it is, you mentioned that, where someone buys a property in a location where the market still pretty tight, under 2% vacancy rate, which is great.
Yep.
But, you've got a property manager who comes in and they're really trying to woo this client because they might have got several appraisals and they've
overpitch it.
Yeah, $50 over and, all of a sudden that property sits on the market vacant for the next 4 to 6 weeks. And
because the customer believes they can get that because they were told that to start with.
Correct, over-promised, under-delivered, for sure.
That's certainly a big issue and you can't have it empty. I mean, if you leave it empty at $50 a week, it's $2,500 a year. Okay, a $50 difference is $2,500 a year, which after tax is about $1,300. Okay, so it's reasonably significant. So you're better off lowering it slightly and getting them in there and taking the full 52 weeks.
Yeah, but then I guess to counter that, where I see clients make that mistake is it'll be sometimes shocking to me where I'm having reviews with clients and we're putting their previous properties in and I'll be like, cool, what are you getting the rent per week on that one? I'm like, yeah, we haven't changed it. It's like, guys, that rental market's moved 20%. Since you last bought that one. So
they've got a little bit lazy.
Yeah, well, I think it's...
Because they love their tenant. They like the tenant that they're looking after the house, so you kind of tend to do that. So that's a really good example you brought up there. A lot of our customers, when we do the reviews, have left it there at a low rent for a long, 5-6 years, because they love their tenant. And the cost is significant. But they're kind of afraid to actually put someone else in there or put the pressure on the current tenant just in case they're going to leave.
Yeah, and I think that's where you got to manage the risk. I guess it's like anything. A known relationship is better than the unknown one if you've got a tenant that hasn't been causing you issues. So I normally, even for myself with my own properties, I'll have an assessment of where the actual market is at.
Yep.
And I might just be a little bit under it. That might be $10 or $20 less. You got to understand too, if that tenant, if they're going to move, they've got to find a new place. They've got to go to open homes. They might have to hire movers or a moving truck and all those sorts of things. So if you're in and around the mark, but maybe just giving them a little bit of an incentive to stay. But it's when you start to chase those higher returns, that's when you start to get yourself in a little bit of trouble.
And in this market, there's very few issues around the rental side and has been for a long, long time due to the demand that's out there. So my advice is speak to your professionals in regard to it, and rarely do they get it wrong outside, say, $20 a week. And $20 is minimal after tax when you actually do the calculations.
Yeah. Okay, next one I've got for you, Mark. So as for Ripehouse as a buyer's agency, we're a capital growth focused buyer's agency, right? That's our main.
Which is why we love you.
Yep. Yeah. But I guess from yourself, how important is cash flow when you're forecasting returns for a client?
It's important because if you're buying an asset that only returns 30%, or we'll call it 35%, which is the minimum you really want to buy an asset for over, say, 4 to 6 years, the growth you want to make out of that. If you take out purchase costs, sale costs, running costs, if running costs is 15, 18 grand per property, if you hold it for 5 years, you've done nearly 100 grand, 95 grand. Then you've got your purchase costs. If it's an expensive house, say 800K, there's another 50K gone, 55 in Victoria with more expenses here. Then you've got the sale costs. And then you've got the capital gains tax. So it actually eats into that 35% a lot. So I'm really, really big on assets around 500K costing less than or around the 1% mark. Call it 5 grand, maybe 6 grand, capping out after tax, after depreciation. If it's 800K asset, it's probably 1.2, 1.3%, so 10 to 12K. And then when you're talking about $1 million asset in Victoria, plus we are talking about 15 to 20K, which is now getting up to 2%. And that's where it starts to get a bit hefty. So you've got to start doing the calculations there on what return that you guys as a property company can return after taking all those into account. So it starts to get, you've got to do the math.
Yeah. And I guess, so writing that cash flow, because I mean, the reality is there's not really, unless you're buying some, I guess, assets I wouldn't really be comfortable holding as an investor. There's not really cash flow positive properties out there right now, unless you're coming in with a large deposit, whatever it might be.
Bit of a myth. Even with rates coming down, it's a bit of a myth.
Yeah. So the reality is people are paying out of pocket to hold these properties right now. We're banking on the capital growth to come in there and get us the result.
Yes.
And now, I guess maybe talk to us a little bit about buffers in terms of what that actually is in terms of for an investor.
So why clients have buffers?
Yeah. And do your clients, do you set them up with buffers? Like, how do you work that out? What does that look like?
Well, at ALIC, we've got about, call it 4.5 billion in loans. We have about 900 million in buffers at the moment. So we don't have any arrears out of our client base at the moment.
So about 20% around that moment.
Yeah, it's a lot, isn't it?
Yeah.
That's a lot of customers. It's not just their buffers there just in case. That's buffers they're waiting to invest, or they haven't done it yet, or they paid off a house. Because we're doing a lot of selling exit strategies where we're offloading assets to reduce home loan debt, to get the non-deductible debt down. With the advice of the advocate, because obviously we aren't the property advisors, we'd go to you guys to get the advice about selling, and then reduce the non-deductible debt, which means there's a lot of cash sitting around until such time they get back into the market. So we have about 900 million, I just saw it on Thursday last week, sitting in offset, which is money for investors to play with, one, but also two, to protect themselves. So all customers have a buffer. Well, I make sure they do. Some could have a $3 million portfolio and have $5,000. I'm not sure how they live. I need about 100, okay, with my debt level at 10 or 11 mil. I need 100K as a precautionary measure to go to if something happened, I got sick, had to go overseas, or we had property issues, or lost my job, or something like that. So mine's 100. Some people are 200 or 300. Some people are 10. Some people are 30. So it comes down to risk profile and comfort level. But buffers are really, really critical to give you the comfort to invest again, one, and two, have the cash flow and not wait for your tax return to come back, and just for incidental issues, maintenance, problems that you might have that you need to cover.
Now, to the editor, I'm just framing this so then we can edit that. So what I'm about to say is, I've seen clients of yours, and you can just, I want to just say this now.
Yeah.
Where, you might have set them up with a 50K buffer.
Yep.
And when I've run the maths on it, when we look at the negative gearing plus what they're actually at, plus, if they take that negative gearing and pump it into their tax return, that 50K might last them 5 to 7 years.
Yes.
Assuming. Are you comfortable with that? Yeah. You make a great point about the buffers because, when I sit down with clients, a lot of them, they've been working with yourself or your team.
Yep.
They might start off with a 50K buffer as it was set up on the loan to sit in the offset account. And when I actually run the cash flow numbers with them, and on the assumption that they're taking that tax refund and putting it back into the property, they could be holding that property for 5 to 7 years without actually taking anything from their weekly pay.
Yeah.
And that's probably where from a mindset perspective, people get it wrong. I had a client a couple of months ago where he had 4 properties in 2022, saw the rates go from 2 to 6, and all of a sudden those properties are costing him about $3,000 a month, which he couldn't sustain.
Yes.
Panic stations hit.
Yep.
And this is, I guess, the difference between an experienced investor and somebody who's just got themselves a lot of debt but hasn't thought their way through.
Yeah.
Sells those properties off. And that's the first thing he does, right? Panic sells them off.
Yeah.
Where he realised if he actually just went down that strategy of setting up some buffers, he could have held those properties up till now, and they've all basically appreciated somewhere between 40 to 60%. So the buffer piece is really important.
It's not just if there's 50K and it costs 5 to run, it's obviously going to last a long time.
Yep.
So it's not just about that amount. I've spoken in previous podcasts in regard to how you set up the structures. You have your home loan debt over here with an offset there. You have your investment debt over here. And I have an amount in the offset account that runs it all pre-tax. So say you have 4 houses that cost, call it 50K pre-tax. We have the 50K in the offset account. We put it aside. We don't look at it. It just runs. Rents come in. Interest rates, maintenance, management fees, insurance, water come out. And the 50K just dilutes down through the year. And because it's just another method that we could use.
Yeah.
And then what you do is you put the tax refund in there. Okay, and say the net of cost to run those 4 houses was $27,000. Put your 27 in, put your tax refund back in, and leave it there again, while you're focusing over here and clearing your home loan debt. This method I've actually used with a lot of my clients, and it just just makes it simple. Yeah, I just check that the account's got enough money in there 3 times a year. Everything goes in and out of that account. It's separate to my life, and it just makes investing easier.
You mentioned that, separate to your life. Like a lot of people, it's a mental thing, right? It's like,
Yeah.
I need to come up with this 20K or 50K or whatever it might be to keep, where it's like, no, we've already set up the buffer. We're great. We just need to focus now on the primary thing, getting down the bad debt, not the home loan debt.
It is a mental thing. And I do that for school fees as well, which is a bit off topic. But school fees are the same thing. We bought this house to pay for the school fees. We bought it 4 years before the school fees are due. When that grows, it runs the same way I just said there, and that sells to get the funds to pay for the school fees. Where a lot of people, what they'll do is they'll go to work every day to pay school fees for 15 years and then go, breathe, and then start investing, where there's all different ways to do it.
Yep. Also, and which I guess leads to the next question in terms of negative gearing. In the simplest terms,
Yes.
what is it? How does it work? Who does it help? Who does it not help? And when does it, I guess, become dangerous?
A lot of questions.
If you're serious about building wealth through property, you don't just need a loan, you need a strategy. And that's exactly what the Australian Lending and Investment Centre delivers. Australia's most awarded brokerage. They're not just looking at what you can borrow, they'll build you a holistic lending plan tailored to your long-term goals. We use them, we trust them, and so do our clients. So to find out more or to book your complimentary lending strategy session, head to the link in the show notes to connect with the team. Thanks for listening. Now back to the video.
So how does it work? So negative gearing is really simple, okay? I call it the log. I call it log, okay? So it's a loss comes off your gross. So if you've got rent of, say, 20 grand coming in and your costs are 35K, okay? Costs are rent. It costs are maintenance, management fees, insurance, water management fees, land tax, body corporate, okay? The difference between the rent and the costs is 15K. So that loss of 15, so the rent's 20, the cost of 35, that difference there of 15K, we use that 15K and that comes off your gross income. That's the loss comes off your gross, LOG. If you remember LOG, you can remember what gearing is for the rest of your life. And that loss comes off your gross. So if you're on 100K, your 100K goes to 85K. Now, because your employer, in most cases, your employer, not a self-employed, in most cases your employer's paid tax, or nearly all cases of the employer's paid tax. Of that 15K, it's already gone. So on 100K, you pay tax, as a guess, about 22K. So you take home 78. So if that 22K has gone to the ATO, okay, the government come back when you do your assessment return. They go, well, you only earned 85. Why did you pay us tax on 100? And here's some money back. So if you're on 100K, your tax brackets, call it 37 cents. You get your plus Medicare level, you get your tax refund back on that 15K at 37 cents. Okay, which is about, what's that, 15, about 6. So 6K comes back to you to help you pay for it. So that's negative gearing in a nutshell. It's a really simple way to actually understand it. Okay, so negative gearing is dangerous when people don't understand it. Okay, and the second thing is when they actually are buying assets purely for negative gearing reasons. You don't buy an asset for negative gearing, you buy an asset for growth reasons. You're trying to get a return from it. It just assists you to actually get your expense down to that 5 or 6K, where if you can get your running cost to 1%, like I said before, on a 500K asset, it comes down to $5,000 a year. And if yields go up in the next 2-3 years and your debt comes down slightly, it's going to get to 1% pretty quickly. So if you're spending 1% to make 35% or 45% over 4 to 6 years, it's very advantageous. But it can be dangerous if you don't understand it, and it can be dangerous if you're buying purely for tax reasons. It's not for that. It's basically a play to allow you to set up your structures properly.
Yeah, and I guess where I see it go wrong as well, like negative gearing, where I guess people have this thought that, oh, I've negative geared, like let's just say, it's tax time, I've got to go buy a brand new MacBook and I'm going to claim it for work.
Yeah.
So they spend $3,000 on their new work MacBook.
Yeah.
You're not getting back $3,000. So that's the other thing as well. You're not getting back what you're claiming as a loss.
I like the thought of just paying less tax.
Yeah, well, that's it. But I think they think that, you know, I've spent $3,000, I get back $3,000. No, you're going to get back whatever your marginal tax rate is. So if you're 30%, you're getting back, you know, $900 on that $9,000.
You did right, Julian. A lot of people actually think you're going to get a lot of tax back. You don't get a huge amount back, but it's about getting the government to assist you to run it to get your cost down.
Yeah.
Okay. So most of my customers would only get, 20 to 50K tax refunds, which is not enormous depending on what their income is. Yeah. But where the biggest issue is most people, the majority of our database, we're going through Lolly at the moment, through our app at the moment, where the majority of our database only have 1 to 3% of their net income is used for investments. Now, if you ask those people years ago when they were younger and they want to grow net worth and get to X, Y, Z to retire, what percentage of your income would you put towards investments? No one would say 1 to 3%.
Yeah.
But that's everybody. In most cases, a lot of people have 0%, which is concerning in this day and age with inflation and what we need to be worth to retire, and especially in Victoria.
Yeah. And I guess on that, what would you see, your best clients, what are they putting as their net income?
Yeah, the clients we really work on are probably 2 to 4%, 5% of their net income, and we're assessing it all the time. And Lolly will actually assess it for you straight away, instantly, in regard to what percentage of your income goes towards it. So if you're on, I'll give you an example. If you've got two couples on 150K each, so they net about 220K into the household. So 2% is only spending 4,400 of 220K to run investments. That's light on. If you bring 220 net, 150 gross, 110 net times 2 is 220. At 2% is 4.4. That's a pretty low amount, isn't it?
Yeah.
But where people get caught up is they go, but I'm paying this principal portion of this, but that's bringing the debt down.
Yeah.
What are you really allocating to run investments? 4,400, which is it's minuscule compared to what it needs to be able to allow you to get to where you need to get to.
Yeah. And I guess back onto negative gearing, I guess another side, part of negative gearing is depreciation. So that's obviously, when should investors, I guess, prioritize depreciation or depreciation schedules, and when is depreciation kind of overrated?
Well, it should be done straight away. As soon as you buy the property, you should get it done, or the contract's been signed, or you're about to go to settlement, or just settle the asset, get it done straight away. A lot of people don't know about depreciation, about the actual perks you get. Now, we're not tax advisors, but we understand that internal depreciation can be done for the last 10 years, and external is done post-87.
Yep.
So there's normally a bit there. But again, what it does is it's just another element of how we calculate the cash flows, in getting your cash flows down by getting a little bit more tax back.
And I guess for the listeners who maybe don't understand what depreciation is, so depreciation, so you've got your property, your house, not the land component, the house actually depreciates over a 40-year component, and there's certain parts of that depreciation schedule, so that, like your carpets and your blinds, they depreciate maybe in your first 5 or 10, I don't know the exact number, but it doesn't go over the full 40. Your full building cost, the slab. Yeah. So that'll break down. So what we're saying is if you've got a property, it's less than 40 years old, there's going to be some depreciation there. And normally a depreciation schedule will come in, and you normally they'll have a quick assessment remotely of your property and go, whether it's even worth engaging their service.
It's actually post-87, so it's 38 years this year. It's anything post-87, but you only get 40 years of it.
Yeah, correct.
So 40 times, the rate's actually 2.5%, Julian. So 2.5% times 40 is 100%.
Yep.
So you can depreciate the whole thing over 40 years.
Yep.
But anything post-87, it's worth doing a schedule on. And a schedule costs about $600 to $700, depending who you go through. But every one of our clients who has had an internal renovation in the last 10 years or a post-87 property will get a depreciation schedule, and that assists to bring the cash flow down to run that asset.
Yep. And you can even, there's other little creative things you can do. You don't have to go at an even rate at 2.5% over that 40 years. You can fast track it if you know you're at the higher bracket right now, or you're not going to hold the asset for that full 40 years. You can fast track it. There's a few things, but it's essentially another form of negative gearing where you're claiming that loss of the property depreciating in value to, again, help with the negative gearing.
So let me explain how that works then. Before I spoke about the rent of 25 and the cost of 40, so the loss is 15. Yeah. The 6 adds to the 15, so now your loss is 21. Now, if your loss is 21 and your income's 100, the ATO will assess your income as 79.
Yep.
So your tax on 79 is clearly lower than 100, so you get that difference back. So you'd get another 37 cents on the dollar back on 6K, which is another, call it 2,300 on top of the other refund of 6, so you get 8,300 back, which helps to get that actual end cost down.
Yep. All right, so Mark, let's just say we've bought our property, we've got our tenant in place, everything's set. Like, what's the next step? What do we do from here?
Understand your position. So be just sure about the cash flow. So once you bought the house, you'd catch up with your broker and talk through the numbers and the cash flows and how it all works. Obviously, get a tenant, you get the depreciation schedule done, have everything organised, have your spreadsheet filled out. And in our case, all our clients will fill out Lolly in regard to all their details, which will show their pre and post tax and cash flows and everything like that. Don't need spreadsheets anymore. You can just do it all on the new app that we've done. And then from there, it's basically once you get that understanding and you get that comfort, and your broker's an advisor type broker, then they will know when you can go again. So it's about really touching base in 2, 3, 4 months once you've seen the numbers go through. How you're feeling, where you're at, is now the time. And bearing in mind, now's the time, nearly all the time, now is the time. And the reason behind that is because most people haven't got enough net worth at that stage. And especially in this case, the market's moving. okay? And we only want to work to a certain age. And if we're behind the 8 ball, we want to get moving and get a leveraged product to enable wealth to allow you to get into a better position.
Yeah, and I mean, from the clients that I deal with, I'd say less than 1% have I ever had to turn around and say, oh, you've got too many already. Like you've already gone too hard. No,
Quite funny, yeah. I can tell you, I reckon I've had probably 100 people over the years that have just basically, I've had to slow them down.
Yeah, out of thousands, right? So again, we're talking about.
But they're too gun. Yeah, true. But they're too gun ho, and you've got to slow them down a little bit.
Yeah.
But in most cases, it's about we're behind the 8 ball. Let's get moving. Okay. Again, we're a lender, so we can't advise that, but the property advisor, such as you guys at Ripehouse, can actually advise on that. But we can advise on the capacities and the abilities to be able to progress that.
Yeah, because I think the thing is, for buying a property, whether it's $500,000 or $1 million or $2 million, it does take up a little bit of mental real estate for anybody to go through that process. The highs and lows of does your offer get accepted? Do you find a tenant? Are they going to be a good tenant? Just those little things. Even if you've got the buyer's agent in place, you still ride that roller coaster of emotion.
Totally. It's a mental thing. If you're not used to borrowing money, and all of a sudden you've got a $700,000 or $800,000 mortgage, okay, that's a big thing that we need to take into account, which is why we need to understand your risk profile, your comfort level, how you sleep at night, etc. Because you shouldn't be going ahead if it's going to put you into a situation that you can't manage this mentally. But on the other side to it, if it's only $7,000 or $8,000 a year at 1%, and your income's $250,000, and you're only using 1% or 2% of your income to run investments, why wouldn't you go again?
Yeah, and I think that's where most people we deal with on a daily basis, like we talk about, we've had to pump the brakes. Most people are coming to us and they're normally behind where either they want to be or where they should be.
Yep.
And I guess what a lot of people kicking the can down the road is the number one thing that happens all the time, and it's understanding that if you're 35 to 50. This is your peak earning years. You're not going to be realistically earning much more after you get to the age of 50, and even if you are, as you can probably speak to, it starts to get harder to lend, right? Shorter loan terms.
It was harder there for a while.
Yep.
Through the Royal Commission, it got a bit harder for 50-year-olds plus.
Yep.
But now, if you've got an exit strategy, we can lend to those people, because most people will work to 65 these days, or have to work to 65. And in a lot of cases, if you are behind the line or where you should be at your age, it's going to be a lot higher than that, which is why people are investing and doing these things. But it's definitely at those ages you have the higher income and the abilities to do so, and you normally have the mental capacity to do so. So
kids might have finished school, all those responsibilities starting to taper off just as well.
Totally. And at ALRC, most of our customers are investors. 95% of our clients are investors, so they already think this way. But it's just a matter of keeping our clients on track, meeting with them every 6 or 12 months to discuss strategically what they can and should be doing.
Yeah. How do you help clients recognize when a property, is no longer serving them and it's time to, I guess, sell and reposition?
Yes, look, we, as a lender, we aren't there to advise on the property side, but at the same time, we're measuring their growth rates. We're measuring how it's performed. We're measuring how it costs and what it costs to run, okay, and how long they've had the asset for. And so we're sending off lots and lots of questions to our professional partners like Ripehouse to actually discuss this. A property might have reached its peak. It might have done its 40, 45%. It's nearing the top. Or a client's had a need to clear non-deductible debt, get the home loan debt down to release the pressure on the household. So in a lot of those cases, we will say, right, we see that as a situation. Again, we can't say you should sell that house. I might say at times that if I had that house, I'd be selling it to reduce the home loan debt, but I need to get you to an expert to answer these questions. So it's certainly, there could be a time where the asset's actually grown to its peak. It could be a time where it hasn't performed at all. Or it could be a time where things have changed in the household and the income's just not there to run it and it's too costly to do it. So we just get it reassessed again by the professionals.
Yeah, and I guess from some real world examples of what that might be for clients that I've seen us work with in terms of, if we've got a client, maybe that market is doesn't always have to have reached its peak or it's close to its peak. If you've got bad debt, you've got loads of equity.
Yep.
Pays off the bad debt, frees up cash flow, frees up servicing, obviously, and then it's time to go.
Clearing that bad debt. Where people go wrong is clearing that bad debt down. Normally frees up 10, 20, 30K, which allows you to buy 3 other assets. And that leverage effect is extremely powerful.
Yeah. Okay, Mark, so last question for today's episode. So if an investor gets yield, they get tax buffers and the long-term planning right, what does the next 10 to 15 years realistically look like for them?
If you get it all right, it's amazing. It's It's basically a cyclical approach where you're offloading assets at certain growth rates. You're reducing non-deductible debt at certain times. You're freeing up cash flow and the pressure on the household, which is loosening the noose to allow you to free up and do other things. So if you don't put the cue on the rack like a lot of people do, you allocate the money you've actually reduced the home loan debt by, say 10, 20 grand that you don't spend on the home loan now, to go and spend 15 of that to run 2 or 3 properties. So depending on the risk profile of the customer and the comfort of the customer, you would actually, it's quite exciting times to actually replace all that non-deductible with deductible, and then the leverage effect off that higher base, that higher investment base value is significant. That's when you really start to leverage and grow net worth.
I think, I see it almost like a snowball rolling down the hill. The hardest part is just making that capital, making the money. Getting started is really hard.
Yes.
The more you have, the higher your capital base is. It just compounds over time, and the bigger and bigger that snowball gets. But like you're right, where people go wrong is take the foot off the pedal. Yeah, I've bought the 1, bought the 2, and then it's basically just put the handbrake on. The snowball just stays the same.
Which in a nutshell means they're not allocating enough of their net funds, their net income, towards investing. It's still too low.
Yeah.
So they get to this comfort level that I've got the home loan paid off now, or I've reduced it down significantly, I can breathe, but then don't go and take advantage of that really strong position they've just got themselves into.
And continuing to go not only pays off the home loan, that's probably the first thing that people want to get towards.
Yeah.
Then it strengthens up your retirement. Then it strengthens up, what you leave to your kids or your grandkids or your grandkids' kids. Those things really can have a huge impact. And it's not that it's infinitely harder after you get all that. It actually becomes significantly easier, right?
Yeah, absolutely. So if you need to be worth 5 to 7 million to retire in this day and age, say in a Melbourne type area, say you're living in a house, say it's worth 1.3. So in 15 years or so, it might be worth 2.1, call it. Yeah, that's 2.1. And you might, if you're living on 150 grand a year now, or say 100 grand a year now, in 15 years, that might be 160K a year. So to get that 160K, you need about 3.1 million in other investments outside of your house. You need to be worth 5.5. So imagine if you need to be worth 5.5. Imagine what your kids need to be worth.
Yeah.
In say 55 years. It's ridiculous. So it's about really setting it up for future generations.
Yeah, absolutely. Well, Mark, it's been a pleasure having you in the studio again today. It brings us, I guess, to a conclusion of another Powerhouse episode. Big thank you to you, Broker of the Year. And if you're serious about property, or you want a lending strategy that aligns with your long-term goals, make sure to reach out to Mark and the team at the Australian Lending and Investment Centre. We'll have their details in the show notes. They're the best for a reason, and we'll catch all you listeners on the next episode. Bye for now.
Thanks for watching. If you want to avoid underperforming acquisitions, grab our free suburb performance report below. It's packed with data we use every day to guide our clients.